The retirement tax wake-up call. Imagine spending 40 years preparing for retirement and only a few weeks preparing for retirement taxes. It sounds unbelievable, but that is exactly what happens to millions of Americans every year. Most people spend decades building retirement accounts, contributing to 401k plans, saving in IRAs, paying off mortgages, and dreaming about the day they finally leave work behind. They attend retirement seminars. They calculate their Social Security benefits. They estimate their living expenses. But there is one part of retirement that often receives very little attention until it becomes a costly problem: taxes. Many retirees enter retirement believing their tax situation will become simpler once they stop working. After all, if the paycheck stops, shouldn't the tax headaches stop too? Unfortunately, that assumption catches countless retirees completely off guard. The moment you retire, the IRS begins looking at your financial situation differently than it did during your working years. Your withholding changes, your income sources change, your reporting requirements change, and in many cases, your tax obligations change in ways that most people never expect. What surprises many retirees is that the IRS does not send a welcome packet explaining all the adjustments they expect you to make after retirement. Instead, people often learn these lessons the hard way. Some discover them after receiving an unexpectedly large tax bill. Others find out after owing penalties for underpayment. Some are shocked when withdrawals from retirement accounts push them into higher tax brackets. And many realize too late that the withholding they relied on during their working years no longer covers what they owe. The result can be frustrating. You spend decades doing everything right. You save responsibly. You follow the rules. You finally reach retirement. Then suddenly you receive a tax notice you never saw coming. The problem is not that retirees are careless. The problem is that retirement creates an entirely different tax landscape. The rules that worked during your career may no longer apply the same way after you leave the workforce. And the IRS expects retirees to understand these changes, whether they realize it or not. In today's video, we're going to walk through 10 important tax-related actions that many retirees overlook immediately after retirement. Some involve withholding, some involve retirement account distributions, others involve Social Security, estimated tax payments, and reporting requirements that can quietly create expensive surprises if ignored. These are not obscure tax loopholes or advanced strategies used only by wealthy households. These are basic expectations that affect ordinary retirees every year. The unfortunate reality is that many people discover these rules only after they have already made a costly mistake. That is why understanding them early can potentially save you thousands of dollars and a tremendous amount of stress. As we move through the list, you may recognize some issues you have already encountered. You may also discover a few risks that have never crossed your mind before. Either way, the goal is simple: to help you avoid the tax surprises that catch so many retirees off guard during the first years of retirement. Because retirement does not just change where your income comes from, it changes how the IRS sees your entire financial picture. And that is exactly where the first major misunderstanding begins. Why? Retirement creates new tax risks. One of the biggest surprises many retirees face is that retirement does not necessarily make taxes easier. In fact, for many people, retirement can make taxes more complicated than they were during their working years. That sounds strange at first. After all, most people assume that once they stop working, their financial lives become simpler. No daily commute, no work schedules, no employer benefits paperwork, and perhaps most importantly, no regular paycheck. But that assumption often leads retirees directly into one of the most common tax mistakes of retirement. During your working years, taxes are largely automated. You receive a paycheck from your employer. Taxes are withheld automatically. Social Security taxes are deducted. Medicare taxes are deducted. Federal and state income taxes are often withheld before the money even reaches your bank account. At the end of the year, you typically receive a W-2 form summarizing your earnings and tax payments. For many workers, the process operates almost entirely in the background. Your employer does much of the heavy lifting. Retirement changes that system completely. Instead of receiving income from one source, retirees often receive income from multiple sources at the same time. You may receive Social Security benefits. You may receive pension payments. You may take withdrawals from a traditional IRA. You may withdraw money from a 401k. You may earn dividends from brokerage accounts. You may receive interest income. Some retirees own rental properties. Others receive annuity payments. Some continue working part-time while collecting retirement benefits. Individually, each income source may seem straightforward. The challenge is that every source can have different tax rules. Some income may be fully taxable. Some may be partially taxable. Some may have withholding. Others may have none at all. And when multiple income streams begin interacting with one another, calculating your actual tax obligation becomes far more complicated. This is where many retirees get caught off guard. They assume taxes are being handled automatically because they were handled automatically for decades during their careers. Unfortunately, retirement often requires a much more active approach. For example, imagine a retiree receiving monthly Social Security benefits and occasionally withdrawing money from a retirement account. Neither payment may feel particularly large on its own. However, when combined, they can produce a taxable income level much higher than expected. The retiree may not realize this until tax season arrives. That is often when the unpleasant surprise appears. Instead of receiving a refund, they discover they owe thousands of dollars. Even worse, they may owe penalties because insufficient taxes were paid throughout the year. This situation is more common than many people realize. The IRS expects taxpayers to pay taxes as income is earned or received. When you are employed, employers generally help satisfy that requirement through payroll withholding. When you retire, much of that responsibility shifts directly to you. That transition is one of the biggest adjustments retirees must make. The IRS does not automatically calculate the ideal withholding amount for every retirement income source. The IRS does not automatically coordinate taxes between your Social Security benefits, retirement account withdrawals, pension income, investment income, and other earnings. Instead, retirees are expected to monitor these income streams and make adjustments when necessary. In other words, retirement often transforms you from a passive participant in the tax system into an active manager of your own tax obligations. That can feel overwhelming, especially for individuals who spent decades relying on employer payroll systems. The good news is that understanding this risk is the first step toward avoiding costly mistakes. Most retirement tax problems do not occur because people intentionally break rules. They occur because retirees assume the system still works the same way it did during their working years. But retirement changes the rules. It changes where your income comes from. It changes how taxes are withheld. And it changes who bears responsibility for making sure enough taxes are paid throughout the year. Once retirees recognize that reality, they are in a much better position to avoid unpleasant surprises. Because retirement is not just a financial transition, it is also a tax transition, and understanding that difference can make the years ahead significantly less stressful. Once retirees understand why retirement creates new tax challenges, the next question becomes, what exactly does the IRS expect them to do? The first 4 IRS expectations most retirees miss. Now that we've established why retirement creates new tax risks, let's talk about what the IRS actually expects retirees to do. This is where many people encounter their first surprises. The transition from employment to retirement is not just a change in lifestyle. It is also a change in how taxes are managed. Taxable. The key issue is that retirees often focus only on the benefit itself without considering how other income sources affect taxation. For example, withdrawals from retirement accounts, pension payments, investment income, and part-time work can all influence whether Social Security benefits become subject to federal income tax. As income rises, the taxable portion of benefits can increase as well. Needs it. 5 years later, the difference between those approaches becomes surprisingly large. Understand. Required minimum distribution rules. The 5th IRS expectation involves required minimum distributions, often called RMDs. Many retirement accounts allow savings to grow tax-deferred for years. The IRS eventually requires account owners to begin taking minimum withdrawals from certain retirement accounts. This rule exists because the government wants to collect taxes on money that has been growing tax-deferred. The mistake many retirees make is assuming these withdrawals will happen automatically or that they can simply ignore the requirement. Missing an RMD can create significant problems. Even retirees who know about the rule sometimes underestimate its importance. Susan understands her required distribution schedule. She knows when withdrawals must occur and plans accordingly. Robert, however, pays little attention to the requirements. He focuses only on withdrawing money when he feels he needs it. That approach may seem harmless, but failing to properly manage required distributions can lead to penalties, unexpected taxable income, and unnecessary stress. The IRS expects retirees to understand these rules rather than discovering them after a mistake has already occurred. Track IRA and 401k withdrawals carefully. The 6th expectation involves monitoring retirement account withdrawals. This is where many retirees unintentionally create large tax bills. Every withdrawal from a traditional IRA or traditional 401k has potential tax consequences. Yet many retirees view these accounts as personal savings accounts. They need money. They take money. Simple. But the tax impact is often anything but simple. Susan carefully tracks every withdrawal she makes. Before taking money, she considers how the withdrawal will affect her total taxable income for the year. She understands that larger withdrawals may increase taxes. As a result, she spreads distributions strategically whenever possible. Robert approaches things differently. When he wants to renovate his kitchen, he withdraws a large amount. When he purchases a vehicle, he takes another large withdrawal. When unexpected expenses appear, he taps the account again. Each individual decision seems reasonable. The problem emerges when all those withdrawals are added together. By year-end, Robert has generated far more taxable income than he expected. By now, viewers may realize retirement taxes involve much more than filing a return once a year. The next expectations reveal some of the most overlooked details of all, and they can affect retirees long after the decisions themselves have been made. The biggest IRS surprise many retirees discover too late. By now, we've covered 7 important IRS expectations that many retirees overlook. But the final 3 expectations may be the most important of all. Why? Because these rules often determine whether a retiree pays a reasonable amount in taxes or ends up facing a much larger tax bill than expected. What makes these final expectations so powerful is that they are often hidden. Retirees can make perfectly reasonable financial decisions and still create tax problems without realizing it. The issue is not necessarily how much income they receive. The issue is how different sources of income interact with one another. That interaction creates one of the biggest retirement tax surprises many people ever experience. 8. Keep accurate records of retirement income. The 8th expectation is straightforward but extremely important. The IRS expects retirees to maintain accurate records of all retirement income. During working years, tracking income is often simple. Most income comes from a single employer. Retirement changes that. Income may arrive from Social Security. Pension payments may arrive monthly. IRA distributions may occur several times per year. Investment accounts may generate dividends and capital gains. Interest income may come from savings accounts or bonds. Part-time work may create additional earnings. When these sources are spread across multiple accounts and institutions, it becomes easier to overlook important information. Many retirees underestimate how quickly small reporting errors can accumulate. A missing tax document, an overlooked distribution, an unrecorded withdrawal. Each may seem minor individually. Together, they can create confusion, filing mistakes, and unexpected tax consequences. Accurate record-keeping helps retirees understand their total income picture before tax season arrives. Instead of reacting to surprises, they can make informed decisions throughout the year. 9. Monitor tax bracket changes during retirement. The 9th expectation catches many retirees completely off guard. Many people assume retirement automatically places them into a lower tax bracket. Sometimes that happens, sometimes it does not. In fact, some retirees temporarily move into higher tax brackets than they experienced while working. The reason is simple. Retirement income does not always arrive in a smooth, predictable pattern. One year may involve modest withdrawals. The next year may include a large retirement account distribution, the sale of investments, or additional pension income. Those changes can push taxable income higher than expected. The cost of waiting too long. As we wrap up, there is one final lesson that every retiree should remember. Retirement is not the end of tax planning. In many ways, it is the beginning of an entirely new phase. That may sound surprising. After all, most people spend decades associating taxes with employment. Taxes are connected to paychecks, W-2 forms, and annual raises. So when retirement arrives, many assume the most complicated tax years are finally behind them. But as we've seen throughout this video, retirement introduces a completely different set of rules. The income sources change, the withholding rules change, the reporting requirements change, and the responsibilities placed on retirees often increase rather than decrease. What makes this especially challenging is that many retirees do not discover these changes until after a mistake has already occurred. They learn about withholding issues after receiving an unexpected tax bill. They learn about estimated tax payments after facing an underpayment penalty. They learn about required minimum distributions after missing an important deadline. They learn about Social Security taxation after discovering that part of their benefits are taxable. And they learn about income coordination only after realizing they paid more in taxes than they expected. The unfortunate reality is that waiting too long can be expensive. Not because retirees are careless, not because they lack financial experience, but because retirement taxes often involve rules that were never relevant during their working years. Many intelligent, responsible retirees make costly mistakes simply because nobody explained how the system changes after retirement. That is why awareness matters so much. Consider the difference between two retirees. If there is one message to take away from today's discussion, it is this. The IRS doesn't expect perfection, but it does expect retirees to understand the rules that govern their retirement income. And that is why retirement tax planning is not about fear. It is about preparation. It is about understanding how the system works so you can make informed decisions with confidence. Now we'd love to hear from you. Which of the 10 IRS expectations surprised you the most? Was it Social Security taxation? Required minimum distributions? Estimated tax payments? Or perhaps the way different income sources can interact and affect your overall tax bill? Your experience may help another retiree avoid a costly mistake. And if you found this video helpful, be sure to stay with us. Because retirement tax rules continue to evolve, and there are many additional strategies, IRS changes, and retirement planning lessons that can help protect your financial future. In our next video, we'll explore another important retirement tax issue that many Americans overlook until it's too late, and understanding it could potentially save retirees thousands of dollars over the years ahead.